Welcome to the daily briefing from interest.co.nz. I'm David Chaston. Today we review the September trade balance, look at the likely mortgage rate changes coming up, update what's going on with the international credit crunch, and we'll wrap up with what the other media are reporting. The September trade balance continued the surprising gains in exports we first noted last month. Exports were more than $3 billion for the month, the first time ever for a September. That was up almost 6.5% on the same month a year earlier. And the surprise is that most of the increase was from the export of crude oil from the new Tui oil field. The export of crude oil is important in keeping our trade deficit under control. On a year-to-date basis, we are now selling more to the world this year than we did in 2006, and this is the first time in many months that we've achieved such a trend. Imports also are growing on a year-to-date basis, but their growth has been somewhat faster than exports, and our trade deficit is now 5% higher this year than last. In fact, billion-dollar monthly deficits are usually the order of the day in October and November when we go on a spending spree in the lead up to the holiday season. So we really need those crude oil exports to grow if we are to arrest our deteriorating trade balance. There were few mortgage changes this past week while we waited for the Reserve Bank's OCR decision. Westpac tweaked up its 3- and 4-year fixed rates by up to 10 basis points, and a number of small non-bank lenders popped their 2- and 3-year fixed rates down by 10 basis points, including Cairns Lockheed, Astron and Global Home Loans. Wholesale swap rates rose slightly across the board by about 0.1%, and this may prompt some rate adjustments in the coming week. Today we have seen Kiwibank move some rates up, and those non-bank lenders who moved down this past week will probably reverse course this next week. In fact, with wholesale rates rising faster at the shorter end of the rate curve, we expect 1- and 2-year rates to start rising as early as this week because they are starting to come under pressure from wholesale money costs. Margins are unusually tight for the 2- and 3-year fixed rates, and we note that overall margins have not been this tight since the beginning of the year when the housing market was full of exuberance. But that is now not the case. Volumes are way down. October is a dangerous month for markets. The biggest one-day crashes occurred in October 1929, October 1987 and October 1989. The quake on Friday, October the 19th, 2007 was rather like those famous panics. Even in years without black days, October produced negative returns for 9 years of the last decade. Wall Street is increasingly concerned that the US economy may be headed for a recession. The Fed's Beige Book reveals sharply slowing activity. The primary cause is the deteriorating US housing market. Sales of new homes in September were at their lowest level for 14 years, and applications for building permits were well down. Their market has an oversupply of existing homes, and the rate of defaults on repayments is escalating. The IMF, the OECD and the World Bank all picked reduced US economic growth in 2008, but none has picked a decline large enough to be categorized as a recession. US consumers could be expected to show signs of caution in their spending on account of falling house prices and rising oil and petrol prices. This is not happening yet. Retail spending remains strong. Although mortgage finance is tight and hard to come by, some interest rates are declining, led by cuts by the Federal Reserve and the bond market where yields have declined as recession fears increase. The Fed may soon cut again. The 10-year bond yield has fallen in 10 days from 4.7 to 4.37%. Fear of recession exceeds fears of inflation. You can read more about this background piece we have published by Dr. Neville Bennett. It's accessible from the news menu. And finally today, a quick look at what the other media are reporting. GE Money is positioning itself to pick up assets left over from the fallout of the New Zealand finance company sector. GE Money is New Zealand's largest consumer finance company, backed by its global GE parent. Troubled finance company Geneva Finance is closing its branches and laying off staff, but said it would continue to lend through a direct lending centre and mobile managers. The Australian Treasurer Peter Costello fears a global recession may be imminent, driven by America's subprime mortgage meltdown and China's unsustainable economic growth. You can get more news and start with Newsmaker Views on our news page. Join us again tomorrow for the freshest finance news on the web. We'll see you then.